The day the market cracks. You'll see it before the headlines do. Not on a chart. But in people's faces, tight jaws, restless thumbs, the quiet panic of someone refreshing their portfolio like it's a heart monitor. And buried inside that panic is a machine that has survived every crash since the 1970s, oil shocks. Black Monday.com, 2008, pandemics, yet keeps getting stronger. This isn't a motivational speech. It's an investigation. If you want more stories like this, where money behaves like a crime scene, hit subscribe right now. Because by the end you'll know why doing nothing can be the most dangerous advantage in investing. I didn't start this case because I loved index funds. I started it because I didn't trust them. Anything that always works usually hides something. Fine print. Leverage, a fragile loophole, a myth that collapses the moment too many people believe it. But this one kept refusing to die. It took hits that should have shattered it, then came back sharper. So I did what any market detective does. I stopped listening to opinions and started collecting evidence. The evidence wasn't glamorous. It was 50 years of dull, brutal data, recessions stacked like mugshots, bear markets filed like cold cases, and the same suspect walking out of every interrogation room without a scratch. The suspect had many aliases: spy, IVV, VU, different suits, same spine, the S&P 500 index fund, the boring ETF people brag about buying once and forgetting. The one nobody thinks is a thriller, until you realize it behaves like a syndicate. Every era had its own fear. In the 1970s it was oil and inflation, money melting in your hand like ice. In 1987 it was speed, one day of free fall that made smart people look superstitious. In 2000 it was technology turning into religion, then turning into ash. In 2008 it was trust itself, banks, ratings, mortgages, the whole theater collapsing. In 2020 it was a locked world and a silent economy. Different monsters, same pattern: panic, liquidation, regret, and the index fund simply kept walking. Here's the first twist. The ETF isn't really investing in the way most people mean it. Most investors imagine a mind behind the money, a manager deciding, predicting, protecting, but the S&P 500 fund has no mind. It doesn't guess, it doesn't flinch, it doesn't negotiate with fear. It just holds the market's biggest companies in proportion to their size. Like a mirror that refuses to blink. That's not a product, that's a mechanism. And mechanisms don't care about your story. They don't care if you're scared because your job feels shaky, or because your neighbor just bragged about a stock that doubled overnight. A mechanism does one thing consistently, and that consistency becomes power. The ETF's secret isn't that it avoids crashes, it doesn't. It falls like everything else. The secret is what happens during the fall, when humans turn emotional and the machine stays mechanical. I first saw the pattern in a small, ordinary place, a coffee shop near a brokerage office, where men in pressed shirts would sit like gamblers between meetings. In 2008, the same faces came in paler each week. One of them, let's call him Daniel, kept saying the same line like a prayer: "I'm moving to cash until things calm down." He wasn't stupid, he was terrified, and terror has a predictable habit: it sells low, then buys high, then calls it being careful. Daniel wasn't alone. I pulled account statements from every decade I could get my hands on, anonymized, redacted, but psychologically honest. The pattern was almost insulting in its simplicity. People fled at the worst moment, then returned only after the market had already healed. They didn't miss every day, just the crucial days. The kind you never predict. The kind that carry an unfair share of long-term returns. And once you miss them, compounding stops behaving like a friend and starts behaving like a judge. That's where the index fund becomes something darker than a strategy. It becomes a transfer system. When fear forces traders to dump stocks, and when the same traders inevitably chase the rebound, the money doesn't vanish, it changes hands. It moves from the impatient to the patient, from the reactive to the inert. The fund doesn't need to outsmart anyone. It just needs people to keep being people. Panic provides liquidity. Regret provides re-entry. The machine collects the toll. But if that were the whole story, it would still be too fragile. A machine fueled by human mistakes sounds like it should break the moment humans learn. Yet the opposite happened. The more people learned that timing hurts, the more they piled into the ETF. And that's when this case stopped being about personal psychology and started looking like infrastructure, something embedded into pensions. institutions, benchmarks, and the wiring of modern finance. That's when I realized the ETF wasn't merely surviving crashes. It was evolving through them, and the next chapters explain exactly how. And why 2026 becomes a turning point most people will misunderstand. I called it the gravity file, not because it was poetic, because it was literal. Once enough money commits to one index, it starts pulling everything else toward it. Pension funds rebalance around it. Advisors justify themselves against it. CEOs get paid relative to it. Derivatives price risk off it. News anchors narrate the economy through it. The S&P 500 stops being a basket of companies and becomes a reference point for reality. And when reality has a benchmark, money flows like water downhill. This is where the ETF's survival becomes structurally unfair. A normal business lives or dies by its choices. The index fund lives by other people's choices. Every time a retirement plan defaults employees into an S&P 500 option. That's not a vote, it's a forced draft. Every time an institution says, we must own what the benchmark owns. That's not analysis, it's compliance. The ETF doesn't persuade, it absorbs. Most people think of crashes as events. But to an index fund, a crash is also an audition. Weak companies fail the test, get replaced, and the index quietly upgrades itself without press releases or emotional speeches. That's the part nobody feels in real time. The public experiences a crash as pain. The index experiences it as selection pressure. If you could hear the fund speak, it would sound cold. Show me who still has earnings, cash flow, resilience, the rest can leave. I interviewed an old portfolio manager who started before the dot-com bubble. He had the voice of someone who'd watched too many smart people get humbled. He said, "You know what the index really is?" I guessed he'd say, "The economy." He shook his head. "It's a conveyor belt. It pulls winners toward the front and pushes losers off the edge. Investors think they're buying stability, but they're buying a machine that constantly replaces its own parts." Then he smiled like he just told me a secret and dared me to disagree. That conveyor belt has rules. And rules create predictability. Companies that grow become bigger weights. Companies that shrink become smaller weights. This isn't a flaw, it's the engine. People call it concentration risk and they're not wrong. But they're missing the deeper point. Market cap weighting rewards success automatically. It doesn't promise safety. It promises alignment with whatever is winning. And history has a stubborn habit of letting a few giants drag the average upward. Now let's talk about the entry and exit door. Because this is where the public imagination breaks. People picture ETFs as vaults full of stocks. But an ETF is also a wrapper, an efficient on-ramp to the market. It trades like a stock, moves instantly, and invites the same nervous behavior stocks invite. That sounds like a weakness. It's not, because the easiest thing to trade is also the easiest thing for frightened people to dump, and the easiest thing for disciplined people to keep buying. I found an old message board thread from 2009 that still reads like a confession booth. One user wrote, "I can't sleep, I sold everything, I feel sick." Another replied, "I held, I'm buying more." The first person sounded like a human. The second sounded like a machine. Years later, the first person came back to the thread and wrote one line, "I got back in too late." It wasn't a tragedy caused by bad math. It was a tragedy caused by the nervous system. Here's a brutal truth that investors hate hearing. Most portfolios don't fail because the investor picked the wrong fund. They fail because the investor couldn't tolerate looking wrong for long enough. The S&P 500 ETF's greatest feature is not performance, it's social cover. If you own the index, you never have to explain why you chose a weird stock. You never have to justify a contrarian bet. If you win with everyone. If you lose with everyone. That doesn't remove pain. It removes shame, and shame is what triggers bad decisions. I watched this play out in a living room during the 2020 crash. A couple in their 30s. Good jobs, 2 kids, and a spreadsheet they treated like a fire escape plan. The husband wanted to sell because the headlines felt apocalyptic. The wife said, "If we sell now, we're not just losing money. We're admitting we never believed in the plan." That sentence did more risk management than any chart. They didn't sell, they kept contributing. And in the recovery, their account didn't just heal, it surged. The victory wasn't in the market. It was in the moment they didn't flinch. But if the ETF is this powerful, why doesn't everyone do it perfectly? Because the machine's advantage depends on a paradox. It's easy to understand and hard to live. Buy and hold. Sounds like a slogan until the screen turns red for months. Your coworker brags about a hot stock, and your brain starts whispering, maybe you're the only idiot not doing something. That whisper is the true enemy. And in the next chapter, we follow it into the darker territory, where passive investing stops being a personal choice and starts reshaping markets, governance, and the rules of capital itself. The next evidence packet was labeled ownership. At first it sounded boring: share counts, filings, voting rights, but the more I read, the more it felt like surveillance footage from inside a quiet takeover. Because when index funds grow large enough, they don't just track companies, they become the company's largest owners. And when you own enough of everything, you don't need to conspire. The structure does the work for you. Here's the uncomfortable part. Index giants can become permanent shareholders. They don't exit when management gets lazy. They don't sell when a board makes a bad decision. They can't, not really, because their mandate is to hold the index. That sounds stable, but stability has a shadow. If the biggest owners can't walk away, how hard do they fight? How sharp is corporate discipline when the owners are designed to be passive? I sat with a governance researcher who explained it like a crime scene technician. In a normal market, she said, a big shareholder can threaten management by selling or by activism, but passive owners don't have the same incentives. They own everybody. If company A underperforms, company B might outperform. Their job becomes system maintenance, not company improvement. She paused, then added, that's not evil. That's physics. Physics again. The market keeps returning to that word. And physics is exactly why the ETF survives crashes. It's built around flows that don't require belief. Retirement contributions keep coming even when people are scared. Target date funds rebalance even when the news is screaming. Institutions correct allocations even when sentiment is broken. These behaviors create a quiet stabilizer underneath the drama. A mechanical floor that's invisible until you look for it. I wanted to test that idea the way a detective tests an alibi. Pressure it. What happens in real panic? In real panic, leveraged players get margin calls. They're forced sellers. They dump whatever they can. Not whatever they want, but index funds aren't leveraged by design. A passive holder watching a drawdown is not being forcibly liquidated the way a margin trader is. That difference matters. It's the difference between, I'm scared, and, I must sell today. That's why the ETF doesn't typically create the kind of chain reaction collapse people imagine. The bigger risk is slower and stranger: distortion. When too much money buys everything in the index regardless of valuation, price signals can get dull. Some companies get a permanent bid simply because they're included. Some outsiders get starved because they're not. The market becomes less like a debate and more like an automatic playlist. Popular songs stay popular because the algorithm keeps serving them. And that leads to the first, dark suspicion, in this case, a bubble that doesn't pop like a bubble. A bubble usually bursts because it's built on leverage and fragile belief. But what if the inflation comes from relentless flows instead? Retirement money, institutional mandates, benchmark chasing? That kind of bubble doesn't explode. It stretches. It becomes normal. It becomes the baseline. And when the baseline is inflated, everyone feels rich without realizing they're standing on a steeper cliff. I tracked a second suspicion: liquidity. Critics say, what if everyone sells at once? It's a dramatic question, like yelling fire in a theater. But the theater has many exits, and not everyone is in the same row. Long-term retirement money doesn't behave like hot money. Institutions rebalance rather than stampede. And the ETF's creation and redemption process, its plumbing, tends to keep the wrapper aligned with the underlying basket. That doesn't eliminate stress, but it changes the shape of stress. It turns instant collapse into violent oscillation, followed by recovery as flows reassert themselves. But don't mistake this for safety. Survived every crash doesn't mean won't hurt. It means the system has learned how to metabolize pain. Think of it like a city that gets hit by storms every decade. The storms still flood streets. People still panic, but the city rebuilds drains, raises walls, writes new codes, and becomes harder to drown. The S&P 500 became that kind of city, shaped by disaster, reinforced by regulation, and financed by everyone who couldn't afford to opt out. This is where 2026 enters the narrative like a new suspect walking into the room. Not with a mask, but with a change in conditions: the post-hiking world, the stabilization of rates after an aggressive cycle, the return of earnings expectations. and the acceleration of infrastructure spending tied to new technology. When conditions change, behavior changes, and when behavior changes, flows shift. In the next set of paragraphs, we'll follow the money into 2026 and uncover why the best time to buy is almost never when you feel safe enough to buy. In my notes, 2026 wasn't circled in red because I believed in special years. Markets don't care about calendars, but they do care about turning points, moments when a pressure that was crushing valuations stops tightening. In the case file, the pressure had a name: rates. When rates were rising fast, everything with a future got discounted like a damaged product. But when that rise slows, the market stops getting punched by the same hand every month. That's not a guarantee of gains. It's the removal of a headwind, and headwinds matter more than most people admit. I met a trader who'd survived 3 decades by one rule: never confuse fear with information. He told me the rate hike era trained investors to expect punishment for optimism. Every rally got smacked down by another, higher for longer, headline. People learned to flinch. Then, slowly, the headlines changed tone, not bullish, just less sharp. And in markets, less sharp is often enough to shift behavior from panic sell to cautious hold. The public loves clean stories. Either the economy is booming or it's dying. But the S&P 500 doesn't live in clean stories. It lives in messy transitions, exactly where most people make the worst decisions. The file described 2026 as a transition zone: inflation normalizing, rates stabilizing, earnings expected to keep growing. And that combination is dangerous, not for the index, but for human psychology, because transitions tempt you to wait for certainty that never arrives. I saw this waiting behavior in a conference room where an advisor pitched capital preservation to a room of nervous retirees. The slide deck was all soft colors and hard fear. "We'll move to cash until things look clearer," he said, like clarity was a destination. I wanted to stand up and ask one question: when exactly has the world ever looked clear? The room didn't need more finance. It needed a mirror, because the moment you feel safe is usually the moment prices have already moved. If you want to understand why the S&P 500 ETF keeps surviving, you have to study how it uses uncertainty as fuel. Uncertainty doesn't stop contributions. It often increases them through automation. Payroll deductions don't wait for your mood. Employer matches don't pause because of a scary chart. Target date funds don't ask permission before they rebalance. These are not emotional decisions. They're rails, and rails turn chaos into routine buying. The case file included numbers that sounded almost insulting: profit margins hovering near historic highs, a valuation multiple above old averages, dividends still paying quietly in the background. None of it screamed cheap. Yet the file's thesis wasn't cheap equals good. It was stable conditions plus compounding equals inevitable pressure upward over time. That's the difference between a trade and a system. A trade demands perfect timing. A system demands endurance. Here's where the detective part gets uncomfortable. The index doesn't need to be fairly valued to survive. It just needs to remain the default. If millions of people treat S&P 500 as the baseline for adulthood, like brushing your teeth or paying rent, then the index becomes less like an asset and more like a habit. Habits don't die easily. Habits don't panic on Tuesday. Habits don't read doom threads at midnight. Habits keep going, quietly, even when you don't feel brave. In 2026, the file argued, the boring machine benefits from a new obsession that looks exciting: infrastructure spending for next-generation technology. You don't need to worship any one theme to see the effect when big companies spend on capacity. Chips, software, data centers, logistics. The index captures the winners because the winners are already inside it. That's the advantage of owning the stadium instead of betting on one player. But then comes the obvious objection, the one every good investigator expects: what about concentration? The file itself admitted the index is top-heavy. A small group of giants can steer the whole ship. People hear that and imagine fragility. Sometimes they're right, but here's the counterintuitive clue: market cap weighting concentrates because success concentrates. The index isn't trying to be fair. It's trying to be accurate about what the market is rewarding. And if you can tolerate volatility without selling, volatility becomes the price of admission, not the cause of failure. I wrote one line in bold at the bottom of the 2026 section: the real battle isn't valuation. It's behavior. Because even if the setup is favorable, stabilizing rates, resilient earnings expectations, persistent institutional flows, none of it matters if the investor keeps stepping off the compounding treadmill. The S&P 500 ETF survives crashes because it's engineered to keep you on the treadmill. In the next chapter, we'll examine the traps that try to pull you off, FOMO, hot tips, false diversification, and the seductive lie that activity equals control. The first trap has a friendly face. It's called opportunity. It shows up when the market is calm and your boredom starts itching. You look at your S&P 500 ETF and feel nothing, no thrill, no story, no bragging rights. Then a coworker leans in and whispers about a stock that's up 300%. Your brain lights up like it just found a hidden door. The trap isn't greed. The trap is the belief that boredom means you're missing something. I kept a list of what I call confidence purchases. These are investments people buy not because the math is good, but because the emotion is clean. Crypto during euphoria, meme stocks during social proof, thematic ETFs during headlines, a handful of next big thing companies when everyone you know suddenly becomes an expert. The S&P 500 ETF wins not by beating these stories in a single year, but by outlasting the fatigue that comes after the story breaks. The second trap is more respectable, diversification theater. People assume safety comes from adding more tickers. A growth ETF, a value ETF, an international ETF, a bond ETF, a sector ETF, maybe a quality dividend ETF for good measure. It feels responsible. It feels like building armor. But often it's just complexity disguised as prudence, overlapping holdings, duplicated exposure, fees multiplying quietly, and a portfolio so busy you can't tell what's driving it. I interrogated a portfolio once that had 12 ETFs. The owner called it bulletproof. When I mapped the holdings, it was basically the same mega cap companies repeated in different costumes. Tech appeared in the growth fund, the quality fund, the dividend fund, the total market fund, even the global fund through US multinationals. He wasn't diversified, he was redundantly concentrated, paying extra for the illusion of control. The S&P 500 ETF's ruthless advantage is that it removes your ability to overexpress your personality. It turns investing into something closer to hygiene, consistent, unglamorous, preventive. That's why it feels unsatisfying. Humans want narratives. The index offers arithmetic. Humans want to feel clever. The index offers permission to stop performing cleverness. The third trap is the deadliest because it sounds wise. I'll wait for the next dip. People imagine there's a clean entry point, a perfect moment when fear is high and prices are low and the world politely pauses so you can buy. Real dips don't feel like opportunities. They feel like danger, and the moment you recognize a dip is safe, it's usually already halfway recovered. I remember a message from Daniel, the 2008 coffee shop guy, years after the crash. He wrote to me, almost apologetically. I didn't buy in 2009 because it felt like catching a falling knife. Then I waited for the next pullback. Then it never came the way I wanted. And eventually I bought because I got tired of watching. That's the market's cruelest joke. It doesn't punish you for being wrong once. It punishes you for being cautious repeatedly. The index fund doesn't eliminate these traps. It just makes them harder to act on. When your money is already committed to the broad market, you have less temptation to all in on a story. You can still do dumb things. But the dumb things become side quests instead of your entire retirement plan. That's why the fund is described like a wealth machine. It reduces the surface area where self-sabotage can land. And then there's the trap nobody talks about: advisors selling reassurance. I've seen people pay thousands per year for someone to tell them to buy the same S&P 500 ETF they could buy themselves. It sounds ridiculous until you understand what they're really purchasing. They're not buying expertise. They're buying emotional outsourcing. They're paying for a human voice to absorb their fear during crashes so they don't do something irreversible. That's when I realized the ETF's greatest product isn't returns. It's regret elimination. If you own the index, you can't be the person who missed the market because you chased one stock to zero. You can't be the person who bragged about a hot pick and then had to explain the loss. You can't be the person who knew better and still underperformed the baseline. You become average by choice, and average, in markets, is shockingly hard for humans to accept until they've been punished enough to surrender. The next folder in the case was stamped with one word that felt like a warning: distortion. If the S&P 500 ETF is a machine that rewards patience, what happens when the machine becomes too big to ignore? It starts bending the room. When billions flow into the same index on autopilot, capital doesn't merely invest, it allocates by membership. Inclusion becomes a privilege, exclusion becomes a tax, and that's when investing stops feeling like a fair contest and starts feeling like a system with gatekeepers. I followed the trail to a smaller company, innovative, profitable, but not yet large enough to join the index. Its CEO described fundraising like trying to get oxygen outside the stadium. Everyone says they want innovation, he told me, but the money keeps drifting to what's already in the index. It's like the market is wearing blinders. He wasn't blaming anyone, he was describing gravity, when the default choice is to buy the winners you already know. The future struggles to get priced properly. Then there's the opposite crime: zombies. Not horror movie zombies, financial zombies. Companies that should be punished harder for bad performance but survive longer because they're wrapped in the index and held by owners who don't selectively sell. They don't become great, they become tolerated. In a world driven by passive flows, failure can take longer to show up, like a slow leak behind a wall. That doesn't destroy the index overnight, but it changes the texture of the market over decades. The governance angle was the strangest part of all. Imagine being the largest shareholder in hundreds of companies and also having the weakest reason to fight any single battle. That's the passive paradox. If an activist takes over one company and improves it, they win by changing a specific outcome. But if a passive giant pressures one company too hard, they risk rocking the system they're designed to hold. Their mission becomes stability, not heroism, and stability is not the same thing as excellence. I sat in on a shareholder meeting once. Quietly, in the back, the language was polite, the questions rehearsed, the mood ceremonial, but the subtext was power. The votes would be decided not by the loudest voice in the room, but by institutions holding enormous blocks of shares, institutions whose business model depends on being everywhere. Forever. No conspiracy, just ownership concentration behaving exactly as ownership concentration behaves. This is the part critics point at and call it a bubble. They say, if everyone owns the same stocks through index funds, price discovery dies, valuations detach, and one day liquidity vanishes. It's an elegant fear, clean, cinematic, and terrifying, but the evidence tells a messier story. Passive investing can dull price signals. Yes, but it doesn't automatically create the kind of forced collapse that leverage creates. The market can be distorted without being fragile, the way a city can be overcrowded without instantly burning down. Still, distortion has consequences. When the same handful of mega companies dominate the index, they become the narrative of the economy even if they aren't the entire economy. They set sentiment, they set headlines, they set the mood of risk. And when sentiment rides on a few giants, volatility can feel personal, like your future depends on 5 logos. That's not a reason to flee. It's a reason to understand what you actually own, not 500 equal bets, but a top-heavy mirror of modern capitalism. Here's the key insight the case forced me to write in plain language. The S&P 500 ETF survives because it is not designed to be perfect. It is designed to be unavoidable. It will not always be fairly priced. It will not always be broadly diversified. It will not always reflect the real economy, the way your neighborhood feels it. But it will keep attracting money because it offers something no stock picker can reliably sell: a socially accepted path to compounding that requires no genius, only endurance. That endurance is what turns volatility into a test of identity. The index investor isn't just choosing an asset, they're choosing a personality: patient, boring, disciplined, indifferent to headlines. And once that identity forms, it becomes self-reinforcing. People defend it, teach it, build communities around it, and shame anyone who deviates. The ETF becomes a tribe marker. And tribes don't abandon their symbols easily, especially after they've told everyone they're the rational one. But a tribe can become complacent. And complacency is where investigations get interesting. The final question isn't whether the ETF can survive the next crash. It probably can. The question is whether you can survive the part that comes before the crash, the slow temptation to optimize, to tinker, to chase, to improve a plan that already works, until you break it. In the next chapter, we'll close this case with the operational playbook, How to use the machine without becoming collateral damage. How to build rules that protect you from yourself. And how to treat 2026 like a decision point rather than a prediction. I ended the case where most people begin, with a rule. Not a forecast, not a guru quote, an operational rule you can follow when your hands shake. The rule is simple. Decide your plan when you're calm, then obey it when you're not. That's the real advantage of the S&P 500 ETF. It doesn't promise you'll feel safe. It promises you'll have fewer moments where a bad feeling can become a permanent mistake. The second rule is the one people hate because it sounds too small to matter. Automate. If you do nothing else, set a recurring buy, a fixed amount, on a fixed schedule. Like rent, most wealth isn't built by one brilliant purchase. It's built by 1,000 boring ones that happen regardless of mood. Automation turns discipline from a personality trait into a system. And systems outperform motivation almost every time. The third rule is defensive, and it's the one that keeps the machine from turning you into its victim. Keep your emergency cash separate. Crashes don't ruin long-term investors. Forced selling ruins long-term investors. If your life needs liquidity, the market will eventually make you sell at the worst moment. So you build a firewall, 3 to 6 months of expenses. Untouched, so your ETF can be allowed to do what it does best. Recover on its own timeline. The fourth rule is a psychological lock. No portfolio changes during red days. If the market drops hard and your heart rate rises, you are not allowed to sell, rotate, or rebalance into safety in the same emotional window. Give yourself a delay, 72 hours, a week, whatever is long enough for your nervous system to stop lying to you. Crashes are expensive because they force decisions under stress. Delay is a weapon. Use it. The fifth rule is the cleanest way to defeat FOMO. Allow a sandbox. If you want to gamble on a hot stock, a theme, a new trend, give yourself a small, controlled pocket, 5%, maybe less, so the itch has somewhere to go without infecting the core. Your core stays boring and compounding. Your sandbox absorbs your curiosity. Most people do the opposite. They turn the core into a casino and call it learning. Now let's address the scary line in the story. It survived every crash since the 1970s. That doesn't mean it can't fall. It means every fall becomes a chapter in the same pattern: panic, selling, regret, recovery. The index is built to metabolize that cycle. The question is whether you'll volunteer to be the one who sells into the panic and buys back into the relief. Because that's how the machine extracts wealth from humans. This is why doing nothing isn't laziness. It's resistance. It's refusing to pay the market's invisible tax. The tax of overreaction. The tax of timing. The tax of needing to feel in control. Doing nothing is hard because it feels like surrender. But it's not surrender. It's choosing a different battlefield. One where time is on your side and emotion is the enemy. When people ask me what will happen in 2026, I tell them the honest answer: I don't know. And neither does anyone else. But I can tell you what will probably happen to investors. Because investors are predictable. Some will wait for clarity and buy later. Some will chase the next story and abandon the plan. Some will panic on the next big headline and call it prudence. And a smaller group will quietly keep buying the same boring ETF. Month after month, while the world argues. If you want a single image to remember this case by, make it this. 2 doors in the same hallway. Door 1 says, complexity, and it's loud, shiny, crowded with confident people selling certainty. Door 2 says, simplicity, and it's quiet, almost embarrassing, like a gym at dawn. The S&P 500 ETF isn't magical. It's just the quiet door. The wealth it builds doesn't look like a lottery ticket. It looks like a habit that survives your worst days. So here's the closing statement of the investigation. The secret ETF didn't survive because it predicted the future. It survived because it removed the need to predict. It harnessed flows, psychology, and infrastructure into one relentless mechanism: buy the market, let winners grow, replace losers, and keep going. The only remaining variable is you. Will you use the machine, or will you feed it with panic and regret like everyone else? If this story helped you see the market differently, make sure you're subscribed, because the next case file is already open. And it starts with the question nobody wants to ask. What happens when the default choice becomes the only choice?